Good afternoon, everybody. Welcome to today's Australian Equity webinar hosted by myself, Darren Katz, and I'm joined by Ron Shamgar, the head of Australian Equities at TAMIM. As per usual, I won't speak for too long today. Just wanted to go through a few housekeeping notes. If you'd like to ask any questions through the course of today's webinar, please just look on the bottom of your screen. There should be a Q&A button. Click onto that and register your question. I know we do have a few questions already sent in before today's webinar from people looking to get into the front of that queue. So if you do have questions, please feel free to put them onto the Q&A tab. If you just go through to the next slide, that'll go through our disclaimer for today. Essentially, what we're trying to say is this information in today's presentation is not specific to your individual circumstances. It is really very much general in nature, so please don't take it as being specific advice to your circumstances. As usual, if you're looking for advice, please see a professional on that matter. Before I hand across to Ron today for today's presentation, I might just give you a quick run through on TAMIM, Asset Management, the business. I'm pretty sure that most of you are quite aware of us, but for those who are not, a quick run through. We manage roughly $235 million on behalf of just under 500 clients today. Business has been running for about 9 years, and it manages across three separate areas: equities, property, and credit. If you look at the equity segment on the screen, you can see there's two Australian equity portfolios that we operate, which Ron will talk about today, so I won't spend too much time on that. Two global equity portfolios. Within property, we manage both unlisted as well as a listed property vehicle. And then on the credit side, we manage a private debt portfolio. Just to quickly run through it, on the global high conviction side, which is our broader global equity portfolio, this is managed by Robert Swift, has done really well over the last year with a just over a 25% annualized return, and really giving you exposure to the broader global equity market. If you look at our global technology portfolio, that's a fairly new portfolio, has been running now for about 3 months, really looking to give you exposure to the growing technology and innovation segments of the marketplace. And pleasingly, we've seen that up over the 3 months since inception, just north of 10% now. On the property side of our business, essentially we look to buy unlisted or single asset properties in an unlisted vehicle. And really what we're looking for in this part of the business is something that everyone else is stepping away from at that point in time. It really gives us a good opportunity to pick up assets at exceptionally good prices. 5, 6 years ago, we were looking at retail shopping centers and everyone was looking at us and going, have you not heard of the internet? Today, what we're finding is everyone's trying to buy those shopping centers off of us. And again, about 2 years ago, we started picking up office properties and everyone was asking us if we'd not heard about work from home. Well, I guess Elon Musk in the States is about to put that one to an end, with everyone now coming back to the offices for work once again. And then finally, on the private debt or the credit side, we manage a portfolio of investments into private debt, really looking to generate a steady, consistent income stream, which is paid on a quarterly basis. That's delivering roughly about 8.6, 8.7% over the last 12 months and has been exceptionally consistent since inception 6 years ago, with one negative month in that period. So with that, I might actually stop talking and hand you across to Ron. Ron, thank you very much for joining us today. We look forward to our words of wisdom from you. Thank you.
Thanks, Darren, and good afternoon, everyone. Thanks for joining today's webinar. So my name is Ron Shamgar, and I'm the head of Australian Equities for TAMIM. I currently manage the two Australian equity funds, the Australia All Cap Fund, which is really our flagship fund, and also the Small Cap Income or Dividend Fund as well. So I'll quickly talk about the track record since I joined, which is basically just under 6 years ago on the 1st of January 2019. Now, these are the calendar year returns over the last 6 years of the All Cap Fund, which is really one of our high-performing funds. Has delivered really strong returns over the last 6 years, annualizing about 17% per annum net of fees in the last 6 years. What's interesting is that, as you can see, apart from one year, 2022, which I'll talk to in a second, pretty much over the last 5 out of those 6 calendar years, we have averaged 30% per annum net of fees, and it's been sort of fairly consistent. As of today, for the calendar year 2024, the number that you see there, the 20%, that was at the end of October, but I'm pleased to say that as of today, the fund is up approximately 28% for the calendar year net of fees. And so, with a month to go, we will probably finish around that 30% number if things keep going the way they are. What's interesting is that, although we're quite confident that over the long term, 3 to 5 year periods, we can generate double digit sort of 15% returns on average. But when we start a year, we really aspire to hit that sort of 30% return number. And sort of the way we do it, we build a portfolio of 25 to 30 companies, and we map up, the catalyst, what's going to drive a re-rate for each individual company. We obviously buying companies that we feel are undervalued by up to 50%. So we feel there's at least 50% upside if everything goes perfect for us in the next 12 months. And then we sort of reduce that back to sort of a probability outcome. And sort of that's how we map out our portfolio, where we think we can generate much more than the sort of the average 15% plus per annum. And so far, over the last 6 years, it worked really well. We had one bad year, that was 2022. That was probably the top 5 worst bear market in the last 100 years. The Nasdaq was down 34%, the S&P was down 24%. So it was a very tough year. And obviously, because we are investing in small and mid caps on the ASX, they tend to get hit harder when the market sentiment is quite negative. 2022 was obviously a bear market, as we had rising inflation and very aggressive rate hikes in the US and in Australia as well. So that was very negative for equities. And I'll talk about why we see things have changed and why we're very optimistic for the next few years. So I'll go to the next slide. This just basically highlights that over the last 5+ years, had you invested $1 million in the fund, you'll have approximately $2.5 million net of fees. So a 16-17% per annum is about 2.5 times your money every 5 years, and we think we can then continue delivering these sort of returns over the long term. So today there'll be 4 parts to this presentation. I'll talk a little bit about why we're optimistic for next year and beyond. Talk about sort of where I feel we are in equity markets and why I do not believe that equity markets are overvalued or we're anywhere near a bubble. Then I'll talk a little bit more specifically about companies and what kind of characteristics we look for in companies that we invest in. We'll talk about takeovers. There's been a lot of them, and we've been involved in many takeovers. And so I'll talk about sort of some insights and what we look for potential targets, and maybe a little bit of crystal ball gazing. And then we'll talk about some of the core portfolio holdings that we have, and then we'll do Q&A. So just before I start, I just want to highlight that, we are an Aussie equity funds and we only invest on the ASX. But in order to understand where markets are going, you have to really focus on the US economy and the US equity markets. If you don't understand that, well, then you don't understand how the markets work. But essentially, everything revolves around the US economy and their markets. And so if you understand their economy, their markets, their interest rate cycle, and so on, and you can sort of anticipate what's happening there, that's what's going to drive investor sentiment in Australia. And if you pick the right companies, then you're going to do really well. So, as I spoke about before, about 2022, that bear market was really driven by high inflation and very aggressive rate hikes. And all those risks that drove markets down 2 years ago, that's all basically subside. And now, we pretty much have inflation in the US under control. In Australia, we're probably about, 6 to 9 months behind the US. In the US, as of a month ago, the core inflation moved down to around 3%, which is sort of at the higher end of what they're sort of targeting. And we have, many economists in the market, and also the Fed is pretty much expecting and a signal that it will keep cutting rates over the next 6 to 12 months, down to probably, sort of high threes or 4%. Now, historically, just like, small and mid caps got absolutely smashed in 2022, the opposite applies. So, small caps do tend to outperform during a rate cut cycle, which we're, in the midst of. And also markets tend to do really well if a recession is avoided following the first rate cut. Now, if you look at the chart on the left, it basically shows you historical trends where, after the first rate cut, if you avoid a recession, markets do really well the next 12 months. And so far it's playing out since the first rate cut this year. And obviously, if we do fall into a recession, then, the whole narrative will change. We do not believe the US is about to fall into a recession. And also, now that we have the US elections and that uncertainty behind us, we believe, and many others do, and so do the markets, that the new Trump administration and their focus on cutting regulations and taxes are going to unleash really significant GDP growth in the US, which will be very positive for their economy and obviously for markets. We've all heard about DOGE, the Department of Government Efficiency, with Elon Musk and Vivek. And, if they could just do a little bit of regulation cutting and efficiency in the US government, the GDP growth unleashed in the US will be something spectacular. So watch that space, whether they can deliver. Now, on the right-hand side, we can see basically the S&P 500 since its peak in November 21, it's actually not only recovered, but since a year ago, it's really outperformed the previous high of 2021. Whereas the Russell 2000, which is basically the small cap index, it's just now kind of, breaking even compared to its recent highs in 2021. So essentially what we're saying is that small and mid caps, and, the US is the same as Australia, has significantly underperformed the large caps, and usually they tend to outperform over the long term. Therefore, we believe there is a lot of latent upside in small and mid caps. And we believe that over the next 1, 2, 3 years, we're going to see small caps deliver much better gains than their larger counterparties. So we'll watch that play out. So everyone thinks the market is in a bubble or the market is expensive. So is the market overvalued? Now, we don't believe so. If you look at the US markets, the majority of the performance over the last sort of 12 to 18 months has really been driven by the strong performance of the Magnificent Seven, the Nvidias and Amazon and Googles of the world. That performance was actually driven by very strong profit growth by those companies, and together with a multiple expansion in terms of the share prices. If you actually look at the chart on the left, this is US valuations. And basically, the current market is obviously looking expensive in terms of, trading on maybe 23 times PE compared to its long-term average of about 19 times. But if you take out the Mag 7, the multiple of the market falls to about 18 to 19 times, which is really what it's been averaging over the last sort of 30 years. So we think the market is not expensive if you just ignore those 7 large stocks which have driven. And that's why we think that, you might see the indices maybe struggle to perform like they did in the last 2 years because of the weight of those 7 large stocks within the index. But we think beneath that, if you pick the right sort of more mid caps and small caps, you're going to do extremely well. Now, another measure of market sentiment is measured by IPO activity, which really has been the lowest this year in over 20 years. Now, if you look at the chart on the right, these are basically technology IPOs over the last sort of 15 years. And usually that signifies, if there's exuberance in the market. So as you can see in 2020 and 2021, you had 140 IPOs coming to the market, whereas this year we had 6, last year we had 6. This is not signs of market exuberance, but rather these are early stages of a bull market. And when we get to those 2020 or 2021 levels, then you'll know you're in a bubble. So we believe we are many years away from that. And so the market, in our eyes, is not overvalued, but you obviously got to pick the right companies. So it's very important to sort of take a bit of a big picture perspective on markets and understand sort of bull markets and bear markets. So we believe that we're in a bull market which started pretty much exactly 2 years ago at the end of the 2022 bear market. Going back 50 years, if a bull market makes it past its second birthday, like this current bull market, it's a really great sign of many more years could be left in the tank. So, 5 historical bull markets that made it this far, the shortest of them was at least 5 years old when it ended. So this bull market is approximately 2 years old. And, it's not very old if you look at the past bull markets. The average bull market lasts for about 5.5 years. We're in the third year of this bull market, or we're entering a third year of this bull market. They maybe tend to be maybe a little bit weaker. But the good news is that, if the bull market continues as we expect it will, the following 3 to 4 years are actually really strong. And you can see that in the charts on the left. As you can see, the first 2 years are really good in a new bull market, and we had really good 2 years. And then that continues in the following sort of 3 to 4 years. And we get asked this a lot by investors all the time. When is the best time to invest? And we always say all the time. I think at the end of the day, it's really important to understand that, it doesn't matter whether markets are close to all-time highs. We expect market to continue to go up. If you look over the last 80 years of share market history, and you can see it from the chart below, it pretty much tells you that most of the time markets go up. Every once in a while we get a drawdown or a bear market. They tend to be short and brief in nature. The average bear market is about 12 to 15 months. The last one was 2022, pretty much lasted exactly 12 or 15 months, depending how you measure it. And since then we've started a new bull market. So really the key is to remain invested, and more importantly is to actually sort of top up or invest more during market drawdowns. And we always have to remember that, without the market making new all-time highs, the markets cannot continue to rally. And if the last over 100 years, if markets keep going up, well, you have to keep making new highs. So I think it's important to remember that, and it's more important to focus on the long term and more on the sort of fundamentals of the companies that you're invested in, rather than worry about when's the next correction coming. So what do we look for in a company? There are certain characteristics that we are looking for in the companies that we invest in. We like to invest in companies that are industry leaders. Now, it doesn't have to be the biggest player in its industry, but it has to have a strategic position within its industry, has to have scale, or maybe even a disruptor of various incumbents with new technology or a new better product. These are very good. They tend to sort of be quite strategic and attractive assets for other larger companies looking to grow and acquire them, or maybe new companies looking to enter a new geography, and they're looking to get scale immediately, and they sort of tend to look for sort of an industry-leading business. We like founder-led businesses, so businesses where the founder or the CEO or the management team or the board have very large shareholdings and are aligned with the company interests, and obviously with us minority shareholders. We like management teams that have a track record of execution, whether it's with this business or maybe a previous track record with other businesses. And so we really look at that and other sort of incentives of management teams relative to creating shareholder value. We're obviously looking at profitable businesses. So we're only buying businesses that are growing their revenues and profits. And, we're looking for companies with strong balance sheets. We don't mind some debt, but in many cases, the companies that we invest in have 10, 20, 30% of their market valuation in net cash. We are looking for companies that have low market expectations in many cases. And sort of that can lead to quite cheap valuations. It may be a turnaround story. It could be a misunderstood business, or basically a small cap that doesn't get much coverage and has sort of been left sort of under the radar. We try and find these businesses, meet with the management teams, and understand what's going on before the market can sort of catch on and re-rate the stock, and so we can get in early before they deliver good news or better growth or whatever the situation is. And then very importantly, when we build our portfolio of stocks, we're trying to identify near-term catalysts. So what's going to drive other market participants to re-rate the stock? Because at the end of the day, we don't want to sit in a bunch of cheap stocks that never go up, because that's the recipe for underperformance. So we're really trying to understand, what are the near-term catalysts? Why is that going to drive investors to buy the stock? Could be industry consolidation, strategic reviews, M&A, maybe a trading update, maybe a potential contract win, and so on. So if you really understand that, that's what really drives performance. And that's why, by doing that, we have managed to really perform exceptionally well over the last few years. So, all those attributes that I spoke about, that led us to having 35 or 36 takeovers in a portfolios in the last sort of 5 to 6 years. And that's a lot of companies to get taken over. And sort of the process that we take seems to work and seems to identify companies that eventually lead to a really good outcome for us and obviously other shareholders. So this is a really interesting chart. I spoke about the undervaluation of small caps at the moment and over the last few years. And really a clear sign of undervaluations in the market, and especially small caps, is shown in this sort of takeover premiums being paid over the last 2 years. Now, historically, long-run premiums for takeovers are usually around sort of 30, 40% premium is what needs to get done for a company to get taken out. Now, what's interesting that in 2023, last year and this year, the median takeover premium for a small cap on the ASX was 76%, and the average was 100%. So, obviously, that shows you how small caps and mid caps have been significantly undervalued, and we believe continue to be so. Now, the chart below does show you the premiums that were paid in the last 2 years for a various number of stocks. And we're pretty happy to say that, out of all those stocks, we probably owned about 10 of those. So, that's what drove a really strong performance in the last couple of years. We expect M&A activity to accelerate. We think a lot of these companies are still cheap. We have a very weak Aussie dollar, which is obviously making targets in Australia much more attractive to overseas acquirers. And I think with just a generally slowing global economy, larger companies looking to accelerate their growth, and they have to do it through M&A, and they tend to buy smaller companies. So I'm not going to talk too long about this because obviously this is in the past, but this is a really good case study on 3 stocks that we've owned. They were quite sort of core holdings within the fund that we've identified based on what are the metrics that I've described before. We bought them, and I should mention that each of those stocks at the time wasn't a very exciting story or a stock to own. Their share prices were down massively and nobody was interested. Yet we found businesses that really ticked all the boxes for us, and we were super excited to buy these. So I'll just quickly highlight what they all share the same characteristics. So Silk Laser Clinics, again, second largest skincare clinic network in Australia. As I said, that's an industry leading position. Founder-led biz, ticks the box. Had a very strong balance sheet, paid dividend, was very profitable. And what happened was 2 years ago, late 2022, there was a very negative sentiment to the retail discretionary sector, and that was essentially put in the same bucket. We managed to buy this really great business on 4.5 times EBITDA. We identified that Wesfarmers, through its acquisition of Priceline and skincare clinics, was the ultimate acquirer. We actually wrote about it, and then 4 months later, Wesfarmers bid $3.25. We bought it for $1.75, so we made a lot of money. The next one was Symbio. That was last year. Again, a leading T1 telco software provider, mostly in Australia. It's a very strategic asset within the Australian telco industry. Founder-led business, managing director and the board owned 22%, so tick. Strong financials, recurring revenue. It had a very strong balance sheet. In fact, 40% of its market cap at the time that we bought it was in net cash, which was quite phenomenal. It was still super profitable at the time. And then 2 years ago, what happened was they downgraded in late 2022. We sort of identified and spoke to the company and saw the downgrade not as a structural issue. It was really a once-off issue as an overhang from the COVID lockdown era. And so we managed to buy this company on 3 times EBITDA with 40% net cash. We then wrote about it and we identified it as a classic takeover target for either Superloop or Aussie Broadband. And 6 months later, actually both of them fought over the company and they bought it for $3.15, Aussie Broadband did. And so we made a lot of money there. And then finally, Pacific Smile, that was more recent. So that was end of last year. Again, the second largest dental care network in Australia, ticks the box, industry leading position. Although the management team wasn't the founders, the founder, which owned 10%, led a strategy previously to change the business strategy towards returning to profitability. So that was kind of a tick. Then we had a strong balance sheet. They were in net cash. They reinstated dividends. And finally, after coming out of the COVID period, they finally saw strong growth in both patient revenue and also in EBITDA. They had the 28 million of EBITDA. Now in late 2023, basically had a bunch of funds that got stale, smashed the stock to $1. We managed to buy a business that historically traded on double-digit EBITDA. We bought it for 5 times. Every dental business on the ASX got taken over in the past, and so we could see that this will eventually get taken over. And pretty much, I think it was 2 months later, we got a bid at $1.40. Then 3 months later, we got another bid at $1.90. We sold out eventually, and it's still going through a bit of a takeover thing, but we made a lot of money at the time. And then there was a bid at $2.05, which got rejected, but we already sold at $1.90 at the time. So that's the past. That's kind of hindsight, but obviously at the time it didn't look like these were going to get taken out, but eventually they did. So who could be next? Now, obviously, we don't know. And it's not, you think a company ticks all the boxes and they're going to get taken over, but they might never will. But, if we follow this process and we build a portfolio of these companies, and again, we're not buying companies to get taken out. We're buying them because the businesses are really good. They're growing. They're profitable. We think they're cheap. And if they stay cheap long enough, they usually tend to get taken over. So who could be next? Well, we think these 3 companies have a good chance of being taken over in the next 6 to 12 months. The first one is EML Payments. Now, I'm not going to talk about this one too much because I'm going to talk about it as a core holding in the next slide. But we think EML is now a very high likelihood of being taken over. It's an established global payments business, super profitable. It had a refreshed board and a management-led turnaround, which resolved basically all the regulatory issues of the past. They vested all non-core loss-making divisions. It's got a net cash balance sheet. And it's, as of yesterday, they had their AGM and new strategy day, and they basically reaffirmed guidance. So, it's got 210 million of revenue, 60 million of EBITDA. And they basically said that over the next 4 years or 3.5 years, they're going to get to close to 100 million of EBITDA, 60 million of free cash flow, which at a market cap of 300, screams extremely undervalued. Obviously, the stock has rallied since yesterday, but we still think it's a takeover target. The next one is Comms Group. Probably most people never heard of this company. They're a small sort of telco, IT managed services, and global voice provider in the Asia Pacific region. What's interesting is that although it's relatively small, it's got a very strategic Asian voice network that pretty much no one else has. And so any large corporate business looking to sort of get their whole sort of unified communication network across several countries, they can really use Comms Group, network across Asia, and they're sort of winning contracts this way. The managing director and the board own 23% of the company, so that's a big tick. And financial year 25 is a big inflection point. So, they've got 55 mil of recurring revenue, and they're targeting organic growth of 5 to 10%. They're forecasting 7 mil or more of EBITDA. They'll generate 3 to 4 mil of free cash. They actually started paying dividends last year, and they got a good balance sheet as well. So, they've been winning some global voice deals over the last few weeks. They just announced one 3 days ago with one of the large Mag 7 companies from the NASDAQ. And what's interesting is that Telstra is exiting this market next year. And so it really creates a bit of opportunity to grab some of those Telstra customers. They use Vodafone, Tata as reseller partners. We've seen a lot of industry consolidation in the telco sector. Comms Group trading on 4 times EBITDA. We're currently seeing a takeover battle for Vonex at close to 8 times. Symbio got taken over at 8 times. And so we think that it's only a matter of time before someone like maybe Aussie Broadband makes a move on this one. And then lastly, Clearview. We've been saying it's a takeover target for the last 3 years. Eventually, we'll get it right. Obviously, it ticks all the boxes. It's got a leading sort of mid-tier life insurance business in Australia. It's probably the only left independent life insurance business left. They simplified their business, got rid of all the wealth management stuff, got a strong balance sheet, 71 cents of net assets, 91 cents of embedded value, attractive valuation. They're still sticking to the financial year 26 aspirational target, which they're, well ahead to meet, of 7 cents EPS, 4 cents fully franked dividend. Now they had a couple of weeks ago a bit of a downgrade for this year, and the stock got absolutely smashed, which basically saw in the first quarter of this financial year they had some really bad claims experience of $6 million, which impacted NPAT. It is a bit of a once off, and so obviously it will hit the profit this year, but it doesn't really detract from the valuation of the business, which is really the embedded value of all the future cash flow of the policies that they have. So, we think that, it's on a P of 5. At some point, I think someone is going to make a bid for them. And, we think that with the valuation where it is, it's probably more likely that there will be an opportunistic bid, and, most likely that everyone will accept it considering the share price performance of this one. So I guess these are stocks to watch, then they could be takeover targets, but they still tick all the fundamental sort of things that we're looking for in a company. So I'm going to talk about 4 or 5 sort of core holdings in the fund. And sort of the first one is EML Payments. This is a company that over the last 6 years, we've sort of owned it, sold it, and bought it back. We've actually made a lot of money on this stock over the years. We obviously lost a little bit along the way, and then we made a lot of money again last year. And now the same thing as well. So essentially, this is a global non-bank card issuer. Now, it's probably the second largest in Australia and New Zealand, and it's probably one of the largest global gift card issuers as well. It's got a bit of a diverse market and products that it offers. It has employee benefits programs, which are like salary packaging. It does government disbursements, mostly in the UK. It does gaming, cash out cards and the like. It does travel cards, reward cards. and it's got some financial services as well. It's basically been a bit of a basket case since it had regulatory issues in mid 2021. Essentially, in March last year, it had a refreshed board and management came along and essentially went through a process of resolving all the regulatory issues. That's all done. They divested all the non-core loss-making divisions. That's done. And now the pure focus with a new sort of growth-minded CEO, which presented their new strategy yesterday called EML 2.0, is really focused on growing and growing profitably. And so they got a net cash balance sheet, which is good. And they reaffirmed their guidance for this year, which is about 210 mil of revenue and about 55, 60 mil of EBITDA. They'll generate 30 mil of free cash flow. And, although some investors don't like that a large part of the earnings come from the interest income they earn on the float, on the money that they hold on the card balances of their customers, it's actually a really good type of income. It's annuity. It is very cash generative and it's quite predictable. So it is part of the model. Now, it's a very attractive valuation. It's trading on an EV to EBITDA of about 5 times. The recent M&A transactions in the sector has been done at 10 to 14 times. So if you look on the left, the new strategy is essentially they're going to continue to grow for the next 4 years. They're going to invest a bit in the go-to-market strategy in terms of sales. At the same time, they'll have some savings from reorganization of their current cost base. They're going to invest about $12 to $15 million in a new tech stack to basically bring the whole global business onto the one single platform. That will take about 2 years, but it will generate about $12 million of annual savings at the end of that. So essentially, it will pay itself off really quickly. And they think that their core business is growing at about 5% per annum. And then on top of that, they'll have new business, which will add up to about 10 to 12% annual sort of top line growth. The EBITDA margins, as a result of that, with their cost base remaining flat, will sort of get to 35% in 3.5 years. And I think they can make about 95, 100 mil of EBITDA, 60 mil of free cash flow, which translates to 13 cents earnings per share. The stock is trading around 90 cents. Obviously, it's quite cheap. And we think that now that they've put forward this new strategy, the issues of the past has been resolved. It's almost like a no-brainer for private equity or someone else to come pay 10 times on the current year earnings, so maybe buy it for 500 or 600 mil, and then obviously benefit from the 3-year sort of forecast target. So we think it's a takeover target, and some of the contract wins, next year results, and so on, and execution on this strategy will sort of see it re-rate over the next 12 months or so. The next one is Gentrack. So this is a company we bought 2.5 years ago at $1.50. It's currently trading at $12. So we made about 8 times our money on this one. This is a great business. It's a software business. It's a leading sort of billing CRM software provider for global utilities, energy and water, mostly in sort of UK, Australia, New Zealand, and expanding into Asia. It also got an airport enterprise business called Veovo, which you're probably unaware of, but you've kind of used by just generally using airports such as Sydney Airport and the like. They've been on an upgrade cycle over the last 2 years. They've just done their 5th revenue upgrade. They delivered results yesterday, actually, 213 mil of revenue, which was up 25%. And they had $41 million of underlying EBITDA, $30 million of free cash flow. It really is a great growth business. They're very confident in the medium term of growing top line at 15 to 20%, and EBITDA margins of sort of 15 to 20% as well. And then we believe that over the next sort of 12 to 18 months, their pipeline takes about 2 years to convert. There's some really big T1 logos in there. And we think that they're going to win those or some of those over the next 12 months. and we're talking sort of potentially doubling their revenue. So we think there's some big wins there, and I think the stock will re-rate, and consensus sort of market expectations will have to increase as they win these contracts. Their balance sheet has got 67 million of net cash. The management team, led by Gary Miles, own about 10% of the company. And so really, I think if they could do some acquisitions, maybe for that Viovo business, and win some large contracts, I think the stock could double in the next 12 months. The next one is Superloop. So Superloop, about $1 billion market cap. They're basically a leading, been quite disruptive actually, high growth telco business in Australia. It's in the consumer market. They got about 7% share of all NBN connections. In business, very low cost to serve, and they got wholesale markets as well. They got a big fiber network in Australia, and so they're able to do a lot of white label deals with companies like AGL and Origin, and offer them a white label solution, so these companies can offer a broadband product under their own brand to their customer base. And so they recently obviously won the Origin contract off their competitor, Aussie Broadband, and that was really a game changer for them. Prior to that, they were doing about 54 million of EBITDA. That contract alone is taking them close to $90 million of EBITDA with a few other contracts. So they fully transitioned Origin over, and now as Origin grows, so will Superloop. Just to give you an example, every incremental 50,000 subscribers that Origin adds, and it's added about 100,000 in the last 12 months, it's a 7 million of EBITDA to Superloop. Just to give you an example, Origin is targeting 600,000 subs by the end of FY26. They currently have about close to 200,000. So obviously, unlikely to reach that. But if they did, you can imagine what sort of profit contribution to Superloop. Now, what's interesting is that the challenger brands, as you can see on the left chart, and the chart on the left, the challenger brands have a 20% market share currently. But if you look at overseas and where the trend is heading, it's heading at sort of 30% plus. And so Superloop owned brands, together with its wholesale customers of Origin, AGL, and the likes, they're the challenger brands that are growing, but they all benefit Superloop's bottom line. So it's a really interesting dynamic. They got a strong balance sheet, cash flow is super profitable. We think they'll do some M&A, and which will be very accretive. They had a rejected takeover bid earlier this year from Aussie Broadband, and Origin also owns 10% as part of that deal, with an option to go to 19%. So interesting to watch that. They're trading on about 12 times EBITDA to EBITDA. It's probably fair value for now, but if they do very accretive acquisitions, or if Origin shoots the lights out, then I think the valuation will go much higher. So we'll have to watch that. Another business that we haven't spoken about in the past is called Paragon Care, about an $800 million business. Recently, it basically had it's kind of like a backdoor listing of another business called CH2, which provides pharmacy distributions, a little bit like Sigma and Priceline API. Together with Paragon, it's basically become a very diversified distributor in the healthcare market across the APAC region. They do pharmacy, medical consumables, devices, blood diagnostics, and the like. That merger is going to create significant synergies. So $6 million this year, $12 million next year. It's a founder-led business. So essentially, the three founding directors of CH2 and another business, they own 67% of Paragon. So highly aligned board. They had a very strong trading update at the AGM last week, a 10% upgrade to consensus, 3.7 billion turnover, EBITDA, we estimate around $100 million. Net debt is reasonable. It's a very strong cash generating business. They're currently valued at around 9.5 times EV to EBITDA. If you look at Sigma Healthcare, which has obviously recently merged with Chemist Warehouse, which is kind of a similar business, it's trading at 32 times EBITDA. And we don't think Paragon Care will get anywhere near that multiple, but we think that as it grows over the next 12 months, we think that it could get to about 12 times. And so we think it's worth about 70 cents or 40+% upside from here. and they're looking to do further M&A as well. So we look for them to exceed some of the consensus forecasts in the market and do some M&A over the next few months. Lastly, and the last company we'll talk about is Bravura Solutions. So this is really a classic turnaround case. So we bought this in March, April last year. The stock was 30 cents. It had 100 mil market cap, 80 mil net cash, and it was a $250 million revenue software business. At the time, it had a horrible board and management. It was burning cash. It was loss-making. It was a bit of a basket case. Again, new board and management came along, took complete control of the company, bought 30% of the business, got rid of everyone, installed a really good management teams that understand software. Andrew Russell that ran Class Limited, which we used to own and got taken over eventually by Hub. They simplified the business. They took out $65 million of cost in 6 months, returned to profitability, and they're basically targeting 15 to 20% cash EBIT margins in FY25. So they've gone from loss-making to making 30 mil of cash EBIT this year. And they've got 150 mil of net cash on the balance sheet now, so it's 25% of the market cap. And the board, which is basically a bunch of guys that used to work and run Constellation Software, which is probably the greatest software acquiring company in the world, listed on the Canadian Stock Exchange. They believe that this business should be making 25 to 30% cash EBIT margins. And we think that they could potentially deliver that in the next 12, 18 months, which will be significantly higher than what the market expects. At the same time, they've got quite a lot of capital management initiatives. So they're going to return capital next year. So that will be in Feb, $75 million. They've got a $20 million buyback in place, and they're going to resume dividends probably in February, March results. So that's really good. The valuation is about 10 times EBITDA. Some of their peers are on 14 times. Now, what's interesting is that if they can win a large new logo contract win, which could add anywhere between 20 to $30 million, then I think then this stock will suddenly get a growth multiple, something like Gentrack has. And in the meantime, that sort of margin improvement and capital management, I think will continue to provide support to the stock. And obviously, there could potentially be some M&A. So this is a business that we've made about 5 times our money so far, but we still think there's some really good upside there. And that's sort of the end of the webinar today. We're happy to take questions now.
Ron, thanks for that. Before I hop into the questions, just wanted to reiterate over the last, we lost your screen. Over the last 6 years that you've run this portfolio, the all-cap portfolio has annualized just under 17%. It's really important to note, just one sec, I'm just going to mute you if I can. It's really important to note that through that period of time, we've seen the first iteration of the Trump presidency with tariffs and trade wars with China. We've seen COVID. We've seen inflation. We've seen a huge spike in interest rates. We've seen global conflicts through the Middle East and the Ukraine. And through all of that, we've been able to generate a really strong annualized set of returns. And I think it's really important to note for investors that while equities as an asset class move up and down, our job is really not to pick the asset class and decide what happens in that asset class, but rather to select companies or investments inside of the asset class that we can invest into and hopefully generate returns for our portfolios and hence our investors, which is actually what's happened over the last 6 years and in a previous iteration prior to that. So with that in mind, I might actually head on to your first set of questions. And really, the first couple are talking about Trump and the Trump presidency and tariffs and trade wars coming up. Do you think that's going to be inflationary, and what do you think the impact of that will be on equities? I might have answered it for you, but I'll hand that back to you just to answer that one.
Yeah, sure. Look, we're pretty bullish in terms of the Trump presidency. I think that, as can be seen, I think Trump it's got a very clear agenda, to cut regulations and to cut some of the government spending. And I think that will unleash really good growth in the US. Obviously, he wants to reduce taxes as well, which is positive for company earnings. I think the best way to look, with tariffs, there's a famous saying about Trump, you know, take what he says seriously, but don't take it literally. And I think really the key is that if you look at his last presidency, between 2017 to 2019, those 3 years, I mean, we exclude 2020, that was a bit of a crazy COVID year. The US economy did really well. The global economy did well. Inflation was low, and everyone did okay. And he was still, use tariffs to as a negotiating lever to negotiate better terms for the US. And so I think that, if you look at who is nominated for his Treasury Secretary, which is Scott Bessent, probably one of the more legendary investors, there are around. We're talking work for Stanley Druckenmiller, George Soros is kind of like a mini Warren Buffett. So, if that's the new Secretary Treasury of the US, I think we're in good hands. And tariffs, we'll see how he uses them and if he actually implements them the way he's threatening he will. And I think eventually is that whatever it does, if it benefits the US economy, it's going to benefit the US markets. If the US markets do well, Aussie markets and global markets will do well if you pick the right companies. So, we're quite bullish on the next few years.
Ron, couple of questions here on Close the Loop Group. What are your thoughts on that? There's a bit in the marketplace apparently. Directors telling you historically that the company's share price was not showing or being reflective of its real value. Just your thoughts around them and what happens going forward.
Sure. So Close the Loop Group, we don't own that anymore. So we sold into the bid. We got that stock totally wrong, to be honest. It's a business that, did tick all the boxes for us the last couple of years. But unfortunately, I think the market doesn't really understand or like the business. I think the management team hasn't really executed well. And now they've got a little bit of a debt issue. They didn't really generate much free cash flow at the last results. And I think that they were kind of stuck a bit, with a very low valuation. So they couldn't really raise money. And so we got that wrong. Obviously, there's a bid there from private equity. They're going through a due diligence process. We sold on the bid announced. Obviously there's a risk it might not go ahead. Probably will. They're offering a scrip rollover for the entire board, which owns 40%, which I think is why it's going to go ahead. And they're probably taking a longer term view, so they think that they can probably grow the business out of the sort of market lenses. So yeah, like I said, we don't own it anymore. We lost confidence in the management team, and we sold out. And so that's our view at the moment.
Ron, you operate two portfolios, the all cap portfolio and the small cap income portfolio. When you're looking at the markets currently, are you seeing where are you seeing the opportunities in the marketplace? Is it small caps, mid caps, large caps? Where are you tending to get more excited about investment opportunities right now?
Yes, that's a good question. I mean, look, we're seeing the best opportunities are in the small and mid cap part of the market. Obviously, large caps have done okay, but overall, the index in Australia hasn't really done that well, because most of those large companies are going to struggle to grow, whether it's the sort of commodities ones where sort of, they're more cyclical and obviously they're more exposed to China and commodity prices. The banks have done well, but just generally, I think the large caps have led this sort of rally over the last 12, 18 months. And I think they're going to struggle to perform, and it's going to be small and mid caps, as I've shown, that have been undervalued. They're going to drive the next few years, and you got to pick the right ones, obviously. So we're really finding great opportunities. We've had so many takeovers over the last 2 years, which just highlights how undervalued these businesses are. As we've explained, we've got some really great businesses, profitable, significant scale, great tailwinds, or really good turnaround stories. And I think we will continue to see that the market re-rate them, or we'll just keep getting takeovers for these. And so, yeah, we're pretty bullish on both funds. Obviously, the all cap is a bit more flexible mandate, so it's done much better than the small cap income fund, although that's also delivered sort of double-digit returns over the last 5 years. So sometimes, one fund has a better year than the other. Generally, the all cap performs better just because it's got more of a flexible growth mandate.
So looking at that smaller mid cap segment of the market, sometimes stocks like those tend to have issues around liquidity and being able to get yourself set in positions. If you look at your portfolios, do you have any liquidity issues around any of your positions? What do you think that looks like going forward as, hopefully you do well and get further investors and inflows into your portfolios?
Yeah, look, the good news for our current investors and for any prospective investors is that, we're still a relatively small fund. We're quite nimble. We're not managing $500 million or $1 billion. And so we are able to, get set relatively quickly in many of these stocks. We can sort of remain under 5% of the company. And we've never really had any sort of liquidity issues getting in or getting out over the last 6 years. So I don't think we're going to have any issues over the next few years. Obviously liquidity and a free float in a company is something that we do assess before we actually invest in the company. So if we believe that the company is completely liquid, there is no free float, it's too small, well, we're probably not going to invest in it in the first place. So we look at that as part of our investment process. But generally, I think our average market cap across the portfolio is 300 to 500 mil. So, there's plenty of liquidity for us.
Ron, going through AGM season at the moment, RPG looked like it had a blip. Was it a blip? Do we expect that to recover going forward? What are your thoughts?
Yes, so IPG, yes, they did have a bit of a downgrade, a 10% downgrade. We did hold a small position there, so that wasn't very pleasant. But look, it's a good business. It's a founder-led business. It's very profitable. It's operating in good sectors like data center and electrifications and electric vehicles. They obviously grew by acquisitions. They're transitioning from sort of small ticket item sales to more larger projects. Those larger projects could have longer lead times and obviously a little bit sort of lower margins. And so they had to kind of invest a bit in the OpEx in order to win those larger projects, which I think is what sort of drove down their margins in the short term, which led to this downgrade. But they are saying that the OpEx can now support some really strong contract wins and revenue growth over the next sort of 1 to 2 years. So I think it will benefit them going forward. But, as with any downgrade, you got to, take it with a bit of grain of salt, and you got to watch the next set of results and make sure that this is not the beginning of a string of bad news. So it is a very small holding, and we're going to sort of watch it and reassess at the first half results.
I might just run through two more quick questions. Guess back to that whole thematic about when to invest and what's going on in the marketplaces. We've just seen Warren Buffett sell up a whole lot of his Apple stock and go to cash, quite a big pile of cash, actually. What are your thoughts on that? Should we be betting against Buffett?
Yeah, so actually, Buffett is pretty much reaffirming everything that I said today. So what he's saying to you, Buffett, is that the large mega caps are expensive, and he's selling those. He's not trying to time the market. He's just, he cannot buy the companies that we invest in. He cannot buy the small companies. So he's basically, obviously taking profits in what are very expensive, Apple Mag 7 stock. So, I don't see it as a signal. Historically, Buffett is actually not a good market indicator. He's a great investor, but he's actually not a good market timer at all. In fact, he was heavily in cash during March, April of 2020, and he pretty much didn't buy anything. In fact, he sold his airline stocks, which was probably the worst possible times to sell. So I'm not knocking Buffett. He's the greatest investor of all time. I guess what I'm trying to say is that he's not necessarily a good market timer. He's just a great sort of investor in companies. And I think he's just reaffirming what I've said, is that the large cap stocks, which have drove this incredible rally over the last year or two, are fully priced. And now the rest of the market, the small and mid caps, will carry the market over the next few years. And I think that's where we are going to benefit. And as I showed to you over the 100-year chart, bull markets last 5 to 10 years, bear markets come every 5 to 10 years, and they last for a very short period of time. We've had one in 2022. It's almost never been seen in the last 100 years to have a bear market so soon after a bear market. It just doesn't happen. So to me, together with lower interest rates, lower inflation, a new Trump administration, and obviously we've got this AI tech revolution that's going to drive a lot of innovation and growth. I think we're in for a very good few years. Now, I want to mention one thing, is that the one thing to keep in mind, it's very common to have pullbacks in the market. So even during a bull market, in fact, you should have on average 3 pullbacks every year between 5 and 15%, and you're still in a bull market. This year, we actually only had one, which was if you remember, in early August. The whole world was coming to an end because of the yen carry trade unwind. And for a week there, the market pulled back by 10%. And I'm pretty sure that everyone forgot about that today. So these pullbacks happen. They always happen for a reason, but they're just part of a long-term bull market. And so expect those. And when they happen, use them and take advantage of them to actually invest in the market. And investors over the last 5 to 6 years that have actually took advantage of these drawdowns and invested more in our funds when we were down have actually done a lot better than the 17% per annum.
Good stuff. Thanks, Ron. I might just take this last question. It says, you guys have done really well. Thank you for the presentation today. How would we go about investing into your portfolios or funds if we wanted to? If you're really interested, you can speak to myself or any of our directors, our distribution directors. You're also able to invest online. So if you get onto our website, www.tamim.com.au, you'll find an Invest Now button that you can click onto to invest into. So fairly simple. And if you're having any issues with that, please just let us know and we'll help you out with that. And I suppose to wrap up today's presentation, coming back to when is the best time to invest into equities and to the stocks that we're talking about? Well, I think Ron said it really well earlier. Most of the time is a good time to do that. We've seen through the last 6 years some absolutely crazy markets. We talked about Trump. We talked about the yen carry trade that we've all forgotten about. I'm not sure if anyone remembers the regional banking crisis in the US going back about 12, 18 months ago. These things happen on a regular basis, but for us, the ability to go out there and pick these stocks and actually use those market conditions when they occur to our benefit, to allow us to pick up positions, is certainly assisting our ability to generate strong returns. So if it's something that is of interest to you, we look forward to talking to you further in the future. And thank you very much for joining us today. Thank you for having some confidence in us through the year of 2024. We look forward to speaking to you again early next year. Thanks so much.
Thank you.